Welcome back to The Deep Dive. We're the show that digs through the data to bring you the insights you need, fast. Today, we're diving into the world of financial audits. It can sound dry, maybe, but stick with us. We're focusing on a company, Corley Appliances Co. They sell appliances nationwide, 20 branches, fridges, TVs, the usual stuff. And we're looking at their audit for the year ending August 31st, 20x5. Now, the numbers forecast. $12.2 million revenue, $6.8 million assets, $2.8 million profit before tax. Looks okay on the surface, right? But our mission today is to, well, get behind those numbers. We've got some detailed audit notes here, and they point to some pretty significant red flags. We want to understand what an auditor really looks for to make sure those financials are, actually telling the truth.
Okay, let's unpack this.
Exactly, because an audit, it's really so much more than just ticking and bashing numbers. It's about getting under the hood of the company, understanding how it operates, spotting those potential risks, the things that could make the financial picture misleading, and making sure it's reliable for anyone using those statements, investors, banks, even the managers themselves. And before we even jump into Corley's specific headaches, we have to start right at the beginning. What needs to be set up before an auditor can even, properly start the job?
That's a great point. So before they even walk in the door, what are the absolute must-haves? It's not just a handshake deal, I assume.
Oh, absolutely not. It's like you wouldn't build a house without a solid foundation, right?
Right.
The auditing standards, specifically ISA 210, they lay out very strict preconditions. An auditor literally can't accept or even continue an audit unless these things are locked in. First up, the company has to be using an acceptable financial reporting framework.
Okay, like accounting rules.
Exactly. Something recognized and suitable, like IFRS accounting standards. It depends on the company, its purpose, legal rules, but there needs to be a proper structure for preparing the numbers. Consistency is key. But here's the really critical part. Management. They have to formally acknowledge and, crucially, understand their responsibilities.
What kind of responsibilities are we talking about?
Three main things. One, they're responsible for actually preparing the financial statements according to that chosen framework. That's their job, not the auditor's. Two, they're responsible for setting up and maintaining good internal controls. The checks and balances inside the company.
To prevent mistakes?
Yeah.
Or fraud?
Both. Controls necessary to make sure the financials are free from material misstatement, whether it's accidental error or deliberate fraud. And third, management absolutely must agree upfront to give the auditor full access to all relevant information, records, documents, everything. And access to staff, too, so we can ask questions and get evidence. And what's really interesting here is these aren't just like bureaucratic steps. They form the absolute bedrock. Trust. Transparency. Without management signing up to this, a proper, meaningful audit it can't happen. The auditor basically says, look, if you're not committed to this, we can't give you a credible opinion.
That makes total sense. You can't audit what you can't see or trust. Okay, so that's the foundation. Now let's turn to Corley Appliances itself. The initial meeting between the audit manager and the finance director, it seems that threw up quite a few areas of concern. Our sources highlight 8 specific audit risks.
Right. And maybe before we dive into the first one, let's just quickly clarify for you, our listener, what we mean by audit risk. Simply put, it's the risk that the financial statements might contain a significant error, a material misstatement, we call it. Or maybe even worse, the risk that the auditor fails to spot it. So our job is to figure out where these risks are highest and then design our audit work to, bring that overall risk down to an acceptable level.
Got it. Okay. Risk number 1, a reduced warranty provision. Corley offers a 6-month warranty. They repair defects themselves. But the finance director expects the provision, the money set aside for future warranty, claims to be lower than last year. His reasoning: the products are built to a very high standard.
Yes. And that's a classic red flag right there. Why? Because Corley sells these appliances, they don't actually make them.
Right. So his confidence.
Exactly. His confidence in the quality isn't really a solid, objective reason to just decide the provision should be lower. It's subjective. If that provision is cut too much, it directly understates their liabilities, what they owe or might owe in the future, and their expenses. It makes the company look healthier, more profitable than it might actually be because they're not properly accounting for those potential future repair costs.
So wishful thinking doesn't cut it in accounting.
Pretty much. For an auditor, that kind of management confidence, especially when they don't control the manufacturing quality, it triggers skepticism. It could just be a way to smooth earnings, make the numbers look better. So what do? We'd review how they calculated the provision, look at the assumptions they used. Are they reasonable? We'd check historical claims data. And we definitely look at claims that came in after the year end. That gives us real evidence about the true cost.
Okay, needing objective evidence, not just feelings. Makes sense. Next up, goods in transit and cutoff. Corley's main supplier is in Asia. Goods come by sea, takes up to a month. And crucially, Corley takes responsibility the moment the goods are dispatched from Asia, not when they arrive.
Right, and that immediately flags up what we call cutoff risk, those long transit times plus the specific point of responsibility when it leaves the supplier, not when it hits Corley's warehouse. It creates a high risk that the cutoff for purchases isn't right. Inventory and trade payables could be understated at the year end.
How so? Explain that understatement bit.
Well, think about it. If goods are shipped, say, on August 25th, Corley technically owns them then. They should be recorded as inventory, and Corley should record a liability and amount payable to the supplier. But if those goods are still floating on the ocean on August 31st, it's easy to miss them. If they're missed, inventory is too low and payables are too low. The balance sheet looks stronger than it is.
Ah, okay, got it. So how do you audit that?
We'd need to look closely at Corley's policies for recording this stuff. Check the supplier contracts, verify those shipping terms, the point of dispatch thing. And then we do detailed cutoff testing. That means grabbing a sample of shipping documents for goods shipped just before August 31st and just after, and tracing them to make sure they landed in the right accounting period. Increase the sample size around year end.
Right, detailed checking around that key date. Okay, sticking with inventory. Corley plans a full year-end count, August 31st. Central warehouse and all 20 branches. That's 21 locations. Sounds ambitious for the audit team to cover.
Ambitious is one word for it. It's a logistical challenge, absolutely. With 21 separate counts happening simultaneously, it's pretty much impossible for the audit team to be present at every single one. And that directly increases detection risk. That's the risk we, the auditors, might miss something important, misstatement. It becomes harder to get enough good evidence about how well they control the count process everywhere, and even just confirm the inventory exists and is complete at the sites we can't physically visit.
So you can't be everywhere at once. What's the strategy then?
You have to be smart about it. Prioritize. We'd definitely attend the count at the central warehouse, as that's likely the biggest chunk of value. Then we'd select a sample of branches to attend. Which ones? Probably those with the most valuable stock, or maybe branches that have had inventory problems in the past. Risk-based approach, you see. For the locations we don't visit, we'd have to rely more on reviewing their count records, looking for exceptions or issues they reported, and discussing those with management. But yeah, there's an acceptance of slightly higher risk for those unvisited sites.
Makes sense. Focus your resources where the risk is highest. Okay, let's shift gear to customers and getting paid. Receivables. Corley's collection period, how long it takes customers to pay, it's crept up. Target was 42 days, now it's averaging 55 days over the last 6 months. That seems significant. Yet the finance director apparently thinks no increase in the allowance for credit losses, the provision for bad debts, is needed. He's blaming general industry trends. Does that wash?
Not really. An extended collection period like that is a big flashing warning light. It strongly suggests that some of those debts are becoming harder to collect, maybe even unrecoverable. If Corley doesn't make a proper, adequate allowance for these potential bad debts, their receivables asset on the balance sheet will be overstated. And the related expense, the bad debt charge, will be understated in the profit calculation.
So again, making the company look better than it is.
Exactly. It masks potential cash flow problems and inflates profits. For you, the listener, this is a really common area where management judgment can lean towards optimism. They might genuinely believe things will improve, or they might be reluctant to book the expense. Our job is to challenge that. We'd review their process for assessing recoverability. We'd definitely perform extended testing of cash received after the year end. Did those overdue balances actually get paid? We'd do a detailed review of the aged listing of receivables, looking at specific old balances. And yes, we'd have a direct, probably quite pointed discussion with the finance director about why an additional allowance isn't necessary, especially for balances way past their credit terms.
Okay, challenging assumptions based on evidence. Now this next one sounds serious. A payables fraud. It was uncovered back in June. A payables ledger supervisor was diverting money using a fake supplier account. They were fired, the loss was expensed. What does discovering something like that mean for the audit?
It's a major red flag. It immediately tells you there's a significant weakness in their internal controls. The systems designed to prevent or detect this kind of thing obviously failed. This instantly increases the assessed risk. If this happened, could there be other frauds that haven't been found yet? Is there a risk of management override? Could managers be bypassing controls elsewhere? The whole control environment, the overall attitude towards controls in the company, it comes into question. We can't rely on their internal checks as much as we might have otherwise.
So less reliance on their systems, more direct checking by you.
Precisely. We need to understand the fraud in detail, how it happened, how it was found, what steps management took afterwards, did they look for other similar issues, what new controls did they put in place, and critically, we'd have to perform additional substantive procedures. That means more detailed testing of the payables balance itself. Things like checking supplier details more thoroughly, looking for unusual payments, and we'd specifically make sure that fictitious supplier account has been properly removed and isn't still lurking in the system. And honestly, our overall level of professional skepticism goes way up after something like this. We're naturally more cautious.
Understandable. And there's a direct knock-on effect from this fraud, isn't there? The backlog of purchase invoices. Since the supervisor was dismissed, it seems purchase invoices haven't been getting processed properly. There's a backlog, and they don't expect to clear it by the year-end deadline.
Yeah, that's a direct consequence. Operational disruption leading to potential accounting errors. If those unprocessed invoices, especially ones relating to goods or services received before August 31st, aren't properly accounted for, either by recording them or making an accrual.
An accrual being
Recognizing the expense and the liability, even though the invoice hasn't gone through the usual process yet. If they don't do that, then both purchases expense and trade payables liability will be understated at year end. Again, distorts the picture, makes the company look less indebted, potentially more profitable in that period than it really was.
So more digging required there, too.
Absolutely. We'd have to physically review that pile, that unprocessed invoices file, right at the year end, identify any invoices that relate to the period before August 31st, and make absolutely sure they get accrued for and included as liabilities. And we'd ask management how they plan to clear that backlog, of course.
Okay. Next risk, capitalized training costs. Corley installed a new automated dispatch system, cost $0.9 million. They capitalized this cost, putting it on the balance sheet as an asset, fine. But the $0.9 million included 206 meters for the purchase, 0.2 meters for installation, and also 0.1 meters dollars for staff training on the new system.
And that's where they've likely gone wrong. Accounting standards, specifically IAS 16 on property, plant, and equipment, are quite clear. You can only capitalize costs that are directly attributable to bringing the asset to the location and condition necessary for it to operate as intended. Purchase price, yes. Installation, yes. But staff training costs, generally no. Those are considered necessary for using the asset, but not for bringing it to its working condition. They should be treated as an operating expense, hitting the profit and loss account in the period they're incurred.
So by capitalizing it, what's the effect?
They've overstated the value of their property, plant, and equipment on the balance sheet by $100,000. And because that cost hasn't hit the P&L as an expense, they've also overstated their profit for the year by the same amount.
So another way the numbers look better than they should.
Potentially, yes. It's a common area of error, sometimes genuine misunderstanding, sometimes a way to manage earnings. Our response is clear. Discuss the accounting treatment with the finance director, explain why IAS 16 doesn't allow capitalization of training, and request they adjust the accounts. They need to write off that $100,000 to profit or loss. If they agree, we check the adjustment.
Right, sticking to the rules. Okay, the final risk we identified from the sources, and this sounds like a big one. The renewal of their overdraft facility. This touches on going concern. Because of the cost of that new dispatch system, and maybe those slower receivables we talked about, Corley's overdraft has shot up. It even went over its $4.7 million limit briefly in June. The bank is understandably concerned, and here's the kicker. The bank will decide whether to renew the facility in November 20X5, but the audit report needs to be signed before that in October, and Corley apparently depends on this overdraft.
Yeah, this is critical. This raises significant doubt about Corley's ability to continue as a going concern. That's the fundamental assumption that a company will be able to keep trading for the foreseeable future, usually at least 12 months from the reporting date. If the bank pulls that overdraft facility and Corley depends on it, they might not be able to pay their debts as they fall due. They might not survive. The major audit risk here isn't necessarily that they won't survive, but that the significant uncertainty surrounding their survival might not be adequately disclosed in the financial statements.
So the notes to the accounts might not tell the full story.
Exactly. Users of the accounts, investors, suppliers, even employees need to know if there's a material uncertainty related to going concern. Hiding that would be incredibly misleading. And that timing issue is extremely tricky. The bank makes the call after we sign our audit report. So we have to assess the situation based on the information available in October, knowing this huge decision is pending.
Wow. How do you even approach that?
Intense scrutiny. We discuss it in depth with the finance director. What are their backup plans? Have they looked for alternative financing? We'd perform detailed going concern procedures. That means rigorously reviewing their cash flow forecasts, stress testing them. What happens if the overdraft isn't renewed? Can they realistically cut costs or find money elsewhere? And then, most critically, we evaluate the adequacy of the disclosures in the financial statements. Do they clearly explain the situation, the dependence on the overdraft, the bank's upcoming decision, and the existence of a material uncertainty? If the disclosures aren't good enough, that could affect our audit opinion.
That sounds like a huge judgment call for the auditor.
It absolutely is. One of the toughest areas.
Okay, so we've walked through these 8 specific risks at Corley.
Yeah.
But stepping back, you mentioned earlier this underlying mindset the auditor needs, professional skepticism. Can you expand on that? Why is it so vital?
Sure. Professional skepticism. ISA 200 defines it. It's essentially an attitude. It includes having a questioning mind, being alert to conditions that might indicate misstatement, whether due to error or fraud, and making a critical assessment of the audit evidence you gather. It's not about assuming management is dishonest, not at all. But it is about not just taking things at face value. It's about probing, challenging, corroborating, looking beyond the obvious. It's absolutely essential for digging beneath the surface and potentially uncovering issues that might otherwise be hidden, especially something like fraud. It's like the auditor's built-in quality control mechanism.
Can you link it back to some of the Corley examples? Where does skepticism really come into play?
Oh, definitely. Think about revenue recognition. Auditing standards actually presume a high risk of fraud there. Corley has that 28-day returns policy. How they estimate potential returns involves management judgment.
Judgment equals risk.
Judgment equals risk of bias, yes. Skepticism means we don't just accept their estimate. We challenge the assumptions, look at historical return rates, maybe test post-year-end returns. We question if the policy could be used to inflate revenue near year-end, or the warranty provision. The finance director's confidence about product quality, despite not making the goods. Pure skepticism trigger. We need hard data, not just optimism, especially when reducing a liability makes profits look better.
And the payables fraud.
Massive skepticism alert. A confirmed fraud tells you controls failed. So skepticism means we question all related controls. Could there be more fraud? Is management potentially overriding controls elsewhere? We can't just assume it was an isolated incident involving one person. The bank overdraft situation, too. Huge pressure on management, right? The bank's decision comes after the audit report. So management might be tempted, consciously or unconsciously, to present the most positive picture possible to influence the bank.
So they might overstate profits or understate liabilities.
It's a definite risk. Our skepticism means we have to critically assess all significant judgments impacting the financials in that context. Are they pushing the boundaries on accounting policies? Are estimates overly optimistic? And receivables. The FD saying no extra allowance needed despite collections slowing down significantly. That directly contradicts the evidence. Skepticism demands we challenge that assertion head-on because accepting it means accepting potentially overstated assets and profits. So, connecting it all, professional skepticism isn't about being negative or cynical. It's about being objective, maintaining a questioning stance, demanding persuasive evidence. It's what helps ensure the financial statements provide that true and fair view, especially where judgment, bias, or pressure might otherwise cloud the picture. It protects everyone relying on those numbers.
What an incredible deep dive. Seriously, using Corley Appliances as our case study, we've really seen the whole audit process come alive. From just setting the stage, those preconditions, through identifying all those different types of risks, warranty, inventory, fraud, even the company's survival, going concern, and then tying it all together with that crucial mindset of professional skepticism.
Yeah, the Corley scenario, it really does show how interconnected everything is. Every little operational detail, every management decision, it can ripple through and impact the financial statements. And that's what the auditor has to navigate. It's about connecting the dots between the day-to-day business and those big numbers on the final reports.
Absolutely. And understanding these audit risks and the auditor's approach, it's not just for auditors, is it? It's incredibly valuable for anyone, investors, lenders, even managers who wants to look at a set of accounts and really understand the potential weak spots, the areas needing scrutiny, the real story behind the numbers. not just the polished surface.
Couldn't agree more. It helps you ask better questions. And speaking of questions, maybe one for you, our listener, to think about. We talked about Corley's critical dependence on that bank overdraft and the bank's decision coming after the audit report is signed. That unique timing creates immense pressure. So the question is, how might that specific pressure influence management's decisions and financial reporting in perhaps more subtle ways than the obvious risks we discussed? If you knew about that looming deadline, what other, maybe less obvious red flags might you be watching for in those financial statements? Something to ponder.